Remember sitting in front of the screen one quiet afternoon, watching a position that had grown far beyond what I'd ever risked in my early days. Millions were on the line, not just in potential profit, but in exposure to my own impatience. The candles flickered, the volume whispered hesitation, and I felt the familiar pull, the temptation to overtrade, to chase momentum, to convince myself that I could outsmart time itself. It wasn't fear of loss. It wasn't a single bad trade. It was the slow, invisible drain, the hidden cost that comes from ignoring longevity. Capital can grow, strategies can work, but without discipline stretched across years, even the best trader can collapse under emotional fatigue, burnout, or reckless scaling. I realized then, as I often have over decades, that the market is neutral, but it magnifies every weakness in character, every impatience, every ego-driven move. The lesson isn't about spotting the next trend or reading the perfect candle. It's about surviving the decades, preserving both capital and sanity, and letting experience compound quietly while the impatient destroy themselves. In this video, you'll see the principles that allowed me and traders like Jesse Livermore to navigate markets for decades without burning out, without losing control, and without sacrificing the very capital they worked to grow. Ask yourself, are you trading for quick wins or building a framework that will endure through decades of market turbulence? I remember the first time I scaled a position beyond what I truly understood. It wasn't the size of the capital. It was the weight of responsibility that hit me. $5, $10, $20,000 at risk felt enormous in those early days. Even though by today's standards it was small, I had convinced myself that confidence in my analysis justified exposure. And at first, it worked. Candles moved in my favor. Patterns unfolded perfectly, and the thrill of early success made me believe I was invincible. But the market is patient, and patience has a way of exposing flaws long before capital grows large enough to punish recklessness. I started to notice the subtle costs. Every minor hesitation, every rush decision, every impulsive exit slowly eroded. Not just profits, but my energy, my focus, my capacity for clear decision-making. The hidden toll of early exposure was invisible to the casual observer. It didn't appear in the P&L statement. It appeared in the mind, in the jitter of the hands, in the restlessness that crept into every session. I began to reflect. Am I trading the market or my own impulses? That question haunted me more than any loss. I had to confront a truth most traders ignore. The habits you form when capital is small are the habits that will govern your performance when capital is massive. Early exposure teaches lessons not about price action, but about your own DNA as a trader. I recall one particular day. A stock I had been tracking for weeks finally aligned with a pattern I had studied extensively. On paper, the entry was flawless. On the screen, my position was significant for my account at the time. And yet, hesitation crept in. I second-guessed stops, questioned trend validity, and rationalized scaling too early. The mental tug-of-war was exhausting, and it consumed more tension than the market itself. By the end of that session, I had realized that what mattered wasn't whether I captured the move, but whether I could withstand the internal pressure without breaking my rules. Every trader faces this test early in their career. The hidden cost of ignoring it is not just lost capital. It's the slow erosion of discipline that compounds over years. The market doesn't punish impulsive trades immediately. It waits, and it waits, and it waits, until habits solidify into patterns that can destroy longevity. The lesson was clear. Early exposure is a mirror. It reflects patience, or the lack of it. It reveals the cracks in judgment, the impatience hidden behind confidence, the ego masked as insight. And those who survive decades are not necessarily the fastest learners. They are the ones who respect early warnings, who adjust position size, and who let discipline shape habit before capital grows too large to correct mistakes. I had learned that small capital magnifies psychological lessons. The larger the account eventually grows, the more unforgiving the market becomes. Habits formed early dictate whether a trader thrives or burns out. And if you've managed real capital, you understand the weight of that reflection, the knowledge that today's exposure is tomorrow's habit. and tomorrow's habit is the framework that will carry you or break you over decades. Patience is the currency that separates traders who survive decades from those who burn out in months. Early in my career, I mistook activity for productivity. Every tick felt like an opportunity, every minor pattern an excuse to act. I learned the hard way that impatience is not simply wasted time. It is capital eroded by emotion, discipline, compromised by ego. I recall a moment on a particularly volatile day in the futures market. A breakout formed on the 4-hour chart aligning with multiple indicators I had studied, yet the price lingered at critical resistance. My unrealized gains were substantial relative to my account at the time, and every part of my mind screamed to enter immediately, to capture what I perceived as a sure move. The temptation was intoxicating, but I paused. Pausing is deceptively simple. Watching candles form, waiting for the market to confirm, feels like inaction to the impulsive mind. I felt it, the itch to override my raw, Yuli's to chase, to force alignment between my desires and the market. Ego whispered, "You have studied this, you know it works. Why wait?" Fear countered, "If you hesitate, someone else will take your edge." And yet, I stayed. I let the structure breathe, I let the trend reveal itself. That moment crystallized a lifelong understanding. Patience is not passive. It is active mastery. By resisting impulsive entries, I preserved not only capital, but mental energy, focus, and the ability to see opportunity clearly over the next decade, not just the next hour. The internal battle, the tension between immediate action and long-term discipline, was more intense than any price movement on the chart. I watched the candles fluctuate, volume surge and fade, liquidity shift like tides, and finally, when the alignment met every criterion, I entered. The trade performed exactly as the structure had promised, but the gain was secondary to what I had preserved: my patience, my composure, my trader DNA. I asked myself quietly, would I be able to replicate this clarity after years of volatility and larger exposure? The cost of impulsive trading is subtle, but cumulative. Every premature entry chips away at confidence, increases stress, and accelerates emotional fatigue. Traders who never learn patience are often those who trade longer hours, chase every signal, and eventually burn out before capital compounds meaningfully. The market punishes impatience in ways that no single loss can capture. It punishes it over years, in eroded discipline, frayed nerves, and diminished longevity. Over decades, I came to understand that restraint is the true edge, the ability to wait, to observe, to act only when every rule aligns creates compounding, not just in capital, but in psychological resilience. The trades that mattered most were often the ones I didn't take. The positions I passed on because they die, that Nate meet the standard of discipline, the signals that whispered caution while my ego screamed action. If you've managed real capital, you understand this tension. Patience is heavy. It requires the courage to let opportunity sit, to risk appearing inactive, to resist the dopamine of immediate action. Yet it is the foundation of longevity, the force that allows a trader to navigate decades of market noise without being undone by impulsive decisions. Every patient choice strengthens the framework for sustainable trading, building habits that endure far beyond the next candle, the next lesson, or the next account milestone. There is a subtle danger in trading that few discuss openly: the illusion that one chart can tell the entire story. Early in my career, I learned this the hard way, focusing on a single time frame and believing that short-term movements reflected the full truth of the market. The market is a layered organism, and ignoring its structure across multiple time frames is a silent killer of longevity. I remember staring at a daily chart of a stock I had been following for weeks. The trend was unmistakable: higher highs, higher lows, but the 15-minute candles beneath it were volatile, noisy, screaming for action that didn't exist. My unrealized gains were significant for the size of my account at the time. Impulse beckoned. Should I enter now? Should I adjust the stop? Should I take profits early? The temptation to act on the lower time frame was immense. Every candle felt urgent. Every tick felt personal. And yet, I paused. I reminded myself that the smaller time frame could deceive, that short-term spikes could easily erase gains if not seen in the context of higher order structure. My mind wavered. Rationalization tried to creep in. You've seen this before. You know the pattern works. If you don't act, opportunity slips away. But the truth was that the real opportunity wasn't in reacting, it was in observing. I zoomed out, checked the weekly chart, and allowed the larger trend to inform my judgment. Patterns that seemed critical on the intraday candles resolved themselves. Dominant trend, liquidity flowed along the higher time frame structure, not the noise I had been tempted to chase. This awareness, the ability to reconcile multiple perspectives, became a non-negotiable principle for longevity. One misaligned trade on the wrong time frame might not bankrupt you today, but over decades, it erodes discipline, confidence, and emotional resilience. The hidden cost of ignoring this principle is cumulative. Traders fixated on immediate price action often overtrade, mismanage risk, and burn mental capital far faster than they burn actual capital. Every impulsive move creates friction, a small emotional toll that compounds across years, weakening patience and dulling judgment. Longevity in trading isn't about capturing every swing, it's about consistently interpreting the right signals at the right time, and resisting the lure of the smaller time frame when it contradicts the larger market structure. I learned that day that multi-time frame analysis is more than a technical skill. It is a test of character. It forces a trader to confront ego, to temper impatience, and to honor patience, repeatedly. It demands that you observe, not react, that you respect the market's tempo over the heartbeat of your own desire. Every candle, every cluster of volume, every liquidity imbalance is meaningful, but only when viewed through the lens of context that spans hours, days, and weeks. So, I ask you quietly, are you reacting to the noise, or are you following the structure that will allow you to survive decades? Understanding the interplay of time frames is one of the most overlooked keys to longevity. It is a principle that protects both capital and mind, allowing a trader to navigate years of volatility without surrendering to fatigue, impulsive action, or the hidden pressures of short-term thinking. I have walked through markets where millions flowed and evaporated in hours, where a single misstep could undo years of compounded discipline. It was never the market that scared me. It was my own exposure, magnified by ego and impatience. Early lessons taught me that trading for decades isn't about hitting home runs, it's about surviving innings. And survival, I discovered, begins with ruthless, almost sacred risk management. I remember a trade on a heavily liquid futures contract. My position size was large enough that even a small reversal could carve deeply into my account. Watching the candles fluctuate, I felt the familiar twinge, the urge to widen stops, to chase, to prove mastery over fear. It was seductive. The promise of bigger gains whispered in every spike. My ego wanted to assert control. My capital begged for restraint. I had to confront the truth. Without strict risk boundaries, longevity is impossible. Drawdowns are inevitable. Losses are inevitable. But emotional collapse is optional. By defining exposure relative to both account size and personal tolerance, I preserved the very tool that allowed me to operate in the first place, my capital. And with that, the market became a partner, not a threat. It's not just about stops and position sizing. It's about the internal structure that enforces them. Every time I felt the urge to deviate, to increase leverage, or to catch the move, I reminded myself, one impulsive trade could nullify years of disciplined decision-making. Risk management isn't a strategy, it's a philosophy. It dictates whether a trader survives long enough to compound knowledge to see multiple market cycles, to endure recessions, crashes, and euphoria alike. The subtle costs of neglecting this principle accumulate quietly. Traders who ignore it may enjoy short-term wins, but they pay with stress, sleepless nights, and the slow degradation of decision-making clarity. Emotional exhaustion, overtrading, and eventual burnout are the inevitable companions of unmanaged risk. Longevity requires a mental contract with oneself. Protect the foundation first, profit second. I also learned the power of scaling in alignment with risk tolerance, entering trades incrementally, adjusting as the market validates structure, and never committing capital beyond what my psychology could handle. These were not techniques to maximize immediate gain. They were survival tools. Over decades, these choices compound, not just in account balance, but in confidence, composure, and the ability to trade every market without fatigue or regret. Ask yourself quietly, are you managing risk for profit, or are you protecting the ability to trade tomorrow, next year, for decades to come? True traders measure success not by fleeting gains, but by the capacity to endure. The market rewards those who respect its rules, but it punishes those who forget that every position carries both financial and psychological exposure. Longevity is built not in moments of victory, but in the disciplined management of capital and psyche through endless volatility. Risk management is survival, and survival is the foundation for everything else. Decades in the market teach a lesson that no book, chart, or indicator can fully convey. Trading isn't just about capital. It's about endurance. And endurance isn't only measured by surviving losses or capturing trends. It's measured by the subtle erosion of energy, focus, and mental clarity over years. I have seen it, felt it, and almost come to it myself, the slow, invisible drain that blinds traders before capital does. I remember a stretch during a prolonged bull market. The opportunity seemed endless. Every day, every hour, the chart screamed with potential. My unrealized gains were significant. Yet, I noticed a creeping exhaustion. Decisions that were once precise now felt heavy. Stops were second-guessed. Patterns were overanalyzed. My hands hesitated over the keyboard. My mind raced, and my ego whispered, "You can push harder, you can trade more, you're missing opportunities." This is the hidden threat few speak of. Burnout disguised as ambition. Overtrading, impulsive scaling, chasing signals across time frames. All of it feeds a slow psychological decay. Capital might still grow in fits and starts, but the trader's mind frays. I had to step back not because of losses, but because of fatigue, and confront a difficult truth. Longevity requires pacing, not heroics. I began to study the rhythms of my own energy. Which sessions produced clarity? When did impulsive behavior peak? How long could I sustain focus before judgment became clouded? These reflections weren't about avoiding trades. They were about preserving the mental stamina to trade decades with precision, patience, and discipline. Each lapse I avoided preserved not only capital, but the ability to act decisively when opportunity aligned with structure. I also realized the cost of ignoring emotional drain. Traders who push through fatigue often rationalize, "I'll make it back tomorrow." But emotional losses compound faster than financial ones. Decisions made under mental stress are rarely optimal. Patterns are misread. Stops are mismanaged. Gains eroded. Over time, this slow erosion can destroy both account and confidence. Ask yourself quietly, are you trading markets? Or are you draining yourself in pursuit of fleeting action? True mastery isn't measured by relentless activity. It is measured by resilience, composure, and the ability to sustain clear judgment through years of market cycles. The trader who survives decades is the one who respects both capital and energy, who knows when to step back, when to observe, and when restraint is the most profitable move of all. Burnout is insidious. It masquerades as ambition, tempts the ego, and erodes the discipline that sustains wealth. Those who endure decades understand that emotional preservation is as critical as risk management. Protecting your mind is protecting your capital. And once that principle is internalized, every trade, every decision, and every session becomes an opportunity to compound not just wealth, but clarity and composure. After decades in the markets, after every sleepless night, every winning streak, every near miss, I came to understand one immutable truth. Longevity is non-negotiable. Every principle I've practiced, early exposure awareness, patience over impulse, multi-time frame perspective, risk management, emotional preservation, leads to this single core law: preserve capital, preserve clarity, survive to trade another day. Everything else is secondary. I remember a moment during a volatile crash. Accounts around me were bleeding. Traders were panicking. Positions that had looked safe yesterday now threatened